Okay, so here we are. Second element of the fifth unit. Now we're talking about different disclosure channels. And we start with, maybe the most direct disclosure channel that we can think of, financial reporting in itself. And so to start this off, I thought that it would be nice to think a little bit about the amount of information that is available via financial reports. And for this, I have here a wonderful case study. I picked a German bank, not obviously, but because, this bank actually has a nice repository of their old annual reports available, dating back to the first year of their business in 1870. So this is what you see to the left. And then 2020 obviously is the last annual report that you can find on the webpage of the wonderful Commerzbank. And now I played around with this a little bit, and I simply plot here the number of pages that the annual report has. And so you can also see that I was a little bit lazy, because for the first 80 years of operation, I more or less only took every 10th year, because nothing is going on. So it hovers between 10 and 16 pages. Very short annual reports for one of the largest banks in Germany back then. Okay, so now after the 50s, so you also see the gap of the Second World War. And then after the 50s, you see that there is an increase during the 60s, where the annual report almost doubled in length. The reason why it doubled was the switch to group accounting, right? So in this period, group accounting was introduced in Germany, and the Commerzbank now had to file consolidated financial statements. Then everything was relatively calm. The report of the annual report was hovering around 100 pages, and then the internationalization of reporting happened in the 2000s. And here you see that the Commerzbank report grew in magnitude until close to 400 pages in length. Now today it hovers around 350, but of course the Commerzbank also went through several restructurings, so it's not the same bank that it was in the 19th century, obviously. Now, what I want to show you with this is that, hey, there is a lot of information. And think about, the disclosure processing cost argument that we had in the last element. You see that it might be relatively costly to process all this information for the Commerzbank alone, right? So I think I would like to bet that there is not a single person on the planet that read the annual report of the Commerzbank back to back. Yeah, so I stand to be corrected, but I'm relatively certain that nobody has done it. So that means information processing and acquisition is costly, even if we are aware that the information exists. So awareness is not a big issue here. So market participants know that there is such a thing like annual reports and that they are readily available. Acquiring that information can be very costly. I have a second example here that most of you, I trust, will know. This is a 10K clipping from Apple. And here I took the liberty to focus on what I believe relatively interesting disclosure, actually. And that's the breakdown of the marketable securities that Apple holds across different valuation types, valuation classes, level 1, level 2 fair values. This is interesting for Apple in particular, because Apple has a large chunk of their assets as liquid assets in marketable securities. And here you see this breakdown, and you see here for the fun of it, I clicked on one specific line item, debt securities measured at amortized cost, debt securities that are classified as available for sale, and you see all the information here, from this XBRL tag. So you see, hey, yes, it is not that easy to process all this, and think about also to integrate this. So third point of disclosure processing costs, to integrate this into your decision model as an investor. Right? So yes, these costs will be non-trivial, even if you are a very sophisticated investor. Yeah. So I think it matters to think about how, let's say, these costs affect market outcomes. And just to give you a hint on the literature that evolves around this topic, because this is a rich literature, growing literature as well, very current. I picked like 3 points here, 4 papers that I would like to briefly touch upon because I think they're interesting. So the first paper, Breuer Müller-Hombach, actually looks at the European setting and at private firm data, because in Europe, private firms have to disclose their financial statements under certain conditions, and these conditions vary by size, and they vary also by legal form and over time. So this is really nice for identifying the effects of publicly available financial information. And this Breuer Müller-Hombach paper, I think, makes a very nice point of arguing that the availability of this information across Europe has made it easier for firms to contract with banks at arm's length. So you can think about the banking market as a market that follows 2 models. The one would be the arm's length lending, so on a more or less competitive market. The other would be relationship-based lending, where banks and firms establish a network of trust, and in this network of trust they can actually lend. And of course, the latter, while sounding nice, trust sounds nice, also has its costs attached to it, because there are problems of bargaining or holdups within this very tight relationship. Okay, so I think Breuer et al. Make a nice point in showing that here, when you have information available and information is easily available, so the acquisition costs are being reduced, then this can have an effect on the way that lending markets work, right? So important. You see, disclosure, processing costs matter. So now another setting where a lot of research has been done is EDGAR, so the Electronic Data Gathering, Analysis and Retrieval environment of the Securities and Exchange Commission. And there are several studies that look into the question of whether EDGAR, the introduction of this, actually has had an effect on price discovery. And so the verdict is, I think, yes. There is a paper by Astana et al. In the Accounting Review 2004 that looks at this with a let's say more basic research approach, and then there is a relatively current paper by Gao and Wang in Review of Financial Studies in 2020 that used the staggered adoption of EDGAR, and I think really do a very good job in identifying the liquidity effects of the EDGAR adoption. And one thing that they show is, and this will be very comforting to the SEC, that EDGAR actually helped also individual investors. This is also what Astana et al. Showed to some extent, that they helped also individual investors to trade more on information. Okay, so this sounds nice because it sounds like, okay, EDGAR leveled the playing field, but I'm a little bit cautious. I'd say this verdict is not yet out there, because it's really hard to assess how EDGAR actually has benefited the more sophisticated investors, because also the more sophisticated investors have benefited from EDGAR most likely, and it could be that they benefited even more than the individual investors, and then maybe information asymmetry actually increased because of EDGAR. So I think this is hard to tell, right? So there are several studies that make points related to this, but I'm not entirely convinced. Okay, so now also related to EDGAR, a very a nice new paper that looks. It's a working paper by Heilig, Kaspar, Peter, and Max Müller, available on SSRN, and they use EDGAR outages. So there was an incident some years ago where EDGAR was offline for almost a whole day, and during this day there was EDGAR was very slow in responding or didn't respond at all, and they used this outage to actually infer how this changed trading patterns and liquidity during this day. So interesting paper to pick up and have a look maybe. Okay, so now this is interesting and relates to the next question, whether institutional investors actually use data aggregators. So you can think about EDGAR as a data aggregator, yeah. But also, of course, there are commercial data aggregators like Bloomberg, for example, or First Call, IBIS, CompuStat, you name them, that provide data to investment professionals at a cost. And you see that investment professionals actually subscribe to these data aggregators, so there seems to be a benefit for them. Otherwise, they wouldn't do it. And here, this is a little clipping that actually is not in the paper. So this is a paper by some co-authors, Cascino, Clapworthy, Garcia-Osma, and Shahid Imam, and myself, where we surveyed and interviewed investment professionals, meaning financial analysts, but also mutual fund investors, about their information usage. And while this was not the main purpose of our study, it was also interesting to see how they talk about data aggregators. And there's this one quote, as I said, it's not in the paper, so it's a little bit complicated to cite it if you want. But I liked it a lot because it basically says, we were asking that person, well, what other information sources do you use? And they said, Bloomberg. And I said, yes, but what other information sources? Oh, well, Bloomberg. It's all on Bloomberg. So he basically said that he doesn't use any other information source besides Bloomberg. So of course this is anecdotal, but at the same time gives you an idea that these data aggregators are really important also for professional investors. And here you see that some evidence that actually speaks to this, and there's more than this, and these are just examples. But I think one of the more heavily cited examples is the Shaw paper in Journal of Financial and Quantitative Analysis 2018 that looks at first call, and they see whenever there are delays in first call, so that the analyst forecasts are actually or management forecasts are actually reported with a delay, this triggers longer post-earnings announcement drift. So you see that the aggregators don't use the institutional investors, they don't use the original data per se, but they use the data as being provided by the aggregators. And then you also see that, sometimes these aggregators actually can unlevel the playing field. And this is a nice paper, Roger, Skinner, and Zachman, published in July 2017, that actually made a difference. Because in this paper, the authors show that there was a problem with the Edgar system. So the Edgar system is, of course, publicly available. Everybody can use the Edgar system, but there's also a public dissemination service of Edgar that pushes basically the information out to paying subscribers. There are multiple of these outlets, and this is for convenience reasons, you would think, because it's easier for let's say investment banks or brokerage houses to incorporate this information flow in their tool chain, right? And they're willing to pay for this convenience. But what these authors show in this paper is that's not just convenience, but actually the public dissemination service was a little bit faster than the public webpage of Edgar. And when I say a little bit, I really mean a little bit, because I think the median was 36 seconds. Yeah, doesn't sound that much, but of course in the area of high frequency trading, this can mean a lot. And Rogers et al., they show that the trading activity actually picks up prior to the public announcement, and exactly in this 30-second period, there are, if I recall correctly, 40 or 60, something like this, base points to be made. Yeah, and now these base points over 30 seconds, this is quite a bit of money. So, and I said this paper made a difference, and this is something I really like, because the SEC actually reacted to this. And they said, "Oh, this is not intended, and we want to change the setup so that these PDS services actually get the data after it has been publicly disclosed on Edgar." So I'm not sure actually how this worked out, but it's interesting because assuming that it really is now that way, so that the PDS services actually get the data after it has been disclosed on Edgar, even if it's just some milliseconds after, then this of course would mean that Edgar would get much more traffic recently, because now all the fast traders would like to use data from Edgar, no longer from the PDS. But I've got no idea how this actually worked out. So interesting maybe for you guys to dig out. Okay, so another thing that I also want to squeeze in here, although in principle you might argue it's not really fitting because we're no longer talking about investment professionals, I want to mention that these data aggregators and the way that they treat data, this also matters for us researchers, because we also use data from data aggregators, obviously. And there is a classic paper, I think it's called Rewriting History, that looks into changes of the IBIS database. So that's something that you would not expect to happen, but IBIS has changed in the 2000s. They have changed a substantive body of their recommendations. Ex post. Yeah, it's it sounds a little bit Orwellian even, but it is really interesting. So they changed their recommendations of analysts, which were, when you pulled the data in 2000, they were different from pulling the data in 2007. And it's a little bit unclear why they did this, but it has an impact on research findings. Yeah, and of course, this is something that is a little bit troubling if you are interested in reproducible research, then you would like to see the data to be constant over time. And little spoiler here, the same is true, not to the same extent, but conceptually the same is true also for other data vendors like CompuStat, for example, because they use backfilling and they also fix errors in their data. Of course, this is much less severe than the thing that Lundquist et al. Discovered in IBIS, but it still means that if you repull the same sample from WIDS, for example, you will get different data, very likely so. The differences will be small, but at the same time they're still there. And again, if you're into reproducibility, this can be annoying. Okay, so next thing, and another shameless self-plug, database coverage bias exists, of course, because aggregators don't cover every firm. It's also virtually impossible to cover every firm, and which firms they cover will depend on the demand by their paying customers. And the paying customers, spoiler, are not us, the researchers, but are of course the investment professionals that shovel out a real big K for the databases, right? So, and that means we, as researchers, we should be at least aware that this database coverage exists. And in this working paper, which is, by the way, a review paper of the private firm literature, something that we don't really talk much about in this course, looks into this problem at private firm data, because there it's really pronounced, right? So it's almost by definition, you cannot cover every private firm in the market, so their coverage bias will be, it can be expected to be more severe in the private firm setting, but it is also there in the public firm setting. So something to be aware, right? So that the database aggregators that reduce information processing costs, that they also introduce subtle coverage and selection bias problems that we as researchers should be aware of. Okay, so this is what I wanted to tell you about financial reporting in itself and the aggregators that provide us with financial reporting data. I believe that some of these aspects are actually a little bit overlooked in the literature, so I think it would be great to see more work on how data aggregators change the data that we use as researchers and that investment professionals use for their work. Okay, thanks a lot, and see you when we talk about financial analysts in a second. Bye.